Okay, good evening everybody guys. I'm sorry I'm 10 minutes late. There was some technical glitch out there actually. That is why I was just trying to rectify that. But any which ways, okay. So let's start. I think we need to finish equity today because from tomorrow onwards we have to start with foreign exchange, correct? So I think we would be able to do that because we have lots of time because officially we have 3 hours. Let's see how much time we actually take. Okay, not much I feel because all of you are well prepared. Yes. Okay, yes, good evening Pooja, good evening everybody. Okay, let's start the lecture actually. Okay, so now the next topic that we wanted to do was miscellaneous topics guys. Okay, and the first topic under the miscellaneous equity has got many miscellaneous topics actually, kind of like rights issue, valuation of an unlisted company, and then kind of dividend distribution versus capital budgeting, and then bonus shares, and you have many varieties actually that you need to cover. Good evening, Ronak. Thank you so much. Okay, great. So, Ronak is a CA inter student actually. So, he keeps on coming and just wishing me, good evening, good morning. I'm so happy. Always, it is so nice to see him always there. Okay. So, please prepare well for your exams. Exams are very nearby for you. And just do well in your paper, Ronak. Okay, that's what I can bless you actually. Okay, so all of you, I bless you to have a very, very good paper, and we shouldn't be trying to think that the paper should be easy. Rather, we should be thinking that God gives us a strength to handle that kind of situation. I think that would be a better wish as a teacher. As a teacher, that's what I think. Give me a second, please. Okay, okay, let's start. So the topic is rights issue. Okay, I got it. So rights issue is a topic. So few things about the rights issue, guys. 2, 3 variables. Like it's not a very complicated question though, but it can become a very complicated question if your concepts are not very, very clear actually. So in rights issue, the first of all, what is a rights issue? So if a company is already listed in the stock market, okay, and it wants to issue more shares because it needs money for some new project or something, then definitely it is required out of that company to offer the shares, okay, offer the shares to the existing shareholders first, okay, so that their shareholding is not diluted. Because if the company issues further number of shares, and if the old shareholders are already there, then I am sure that you understand with the logic of your common sense that the shareholding of the shareholders would get diluted. Okay, in order to avoid that, the company is required to first offer those shares to the existing shareholders. Now the shareholders can choose 3 things. Okay, number 1, it can subscribe to the new shares. The price at which the company offers is usually lower than the current market price. Okay, number 2, the shareholder can choose to buy the right shares, number 1. Number 2, it can choose to sell the rights, okay, to someone else actually. Number 3, it can choose to ignore. Okay, in out of 3 situations. But before I start speaking further in this rights share section, I want to tell you something, that any such activity of the company like issuing bonus shares, issuing rights shares or something, the kind of, if you know at all, the total market cap does not change actually, if you are able to understand that part. And it is because of the fact that if that changes, if the wealth of the shareholder changes because of the activity of the company, there would be certain amount of tax liabilities, which may be like the see, everybody is on the brink of their payment of taxes and everything. So suddenly if the company comes out with something, okay, then it will be a problem for the shareholder. So the overall it does not change at all. It is just a rearrangement actually. So whether it is a bonus or a rights issue, okay, but the wealth of the shareholder will not change. Means, suppose I say that the shareholder has got 100 shares, okay, and the price of the stock is 100, okay. So if it buys or subscribes to the new shares, I'll show you some calculations, okay. If it buys or subscribes to the new shares of rights, then there will be no change in the wealth of the shareholder. Before and after, it will remain constant. Okay. Number 2, if it sells the rights also to someone else, if he doesn't buy the right shares for himself, then also the wealth will not change. But the wealth will definitely decrease if the shareholder chooses to not to act. Actually, he has to act. That is the logic here. Okay, so how do you calculate? I've given some formulas here. New number of shares. So amount of money that you need for the project divided by the subscription price. Now what is subscription price? The company can say that we want to issue the subscription. It is not too low actually. I tell you something, it is not very low. It is hardly 15-20% or maybe 10-15% lower than the current market value. But yeah, that is a good benefit for the shareholder. Okay, so desired fund. Suppose I need the amount of money that I need for the new project divided by the subscription price actually. That will give you the number of shares that the company needs to issue as rights. Okay, now number of rights. So existing number of shares divided by new shares will give you the number of rights. For example, it comes to like 5:1. That means to say for every 5 shares held by a shareholder, he will be offered 1 right. He has a right to buy 1 stock at that lower price, that is called subscription price. Okay. Then X rights price, it is basically averaging, guys. Suppose, for example, as I told you 1 second back, that suppose you have 5 shares already, okay, and you are being offered 1 share of right, then what will be the price of the stock after the rights issue? Normal averaging actually. Okay, so suppose the current market price of the stock is 100. Okay, so 5 into 100, and as I said that 1 share is being offered as right. So suppose the subscription price is 80, then what will be the 500 plus 80? The whole divided by 6 will give you the X rights price, 96.67. So it is normal averaging, because after rights, it is not possible for the company to have 2 trading prices in the market, 100 and 180. It is not possible, no. They need to have 1 price only. So we are calculating what would be the price, what should be the price in the market once the shares go X right. So that is how you calculate the X rights price, where MN, I don't use this formula. This formula is ICI's formula. I am not very comfortable. How do I write? I write like this. So it is basically P0 into N0 plus P1 into N1, the whole divided by N0 plus N1. Okay, and we are done. So basically you are averaging things. Correct? No, all of you? Now, next is some questions we need to do in the category, guys. Aggressive Limited is proposing to fund its expansion plan. Okay, Aggressive Limited is proposing to fund its expansion plan of rupees 12 crore by making a rights issue. Okay, what is written? Aggressive Limited is proposing to fund its expansion plan of rupees 12 crore. Okay, so this is the amount of money that I need to raise, okay, by making a rights issue. The current market price is rupees 40. Okay, the board is willing to offer a discount of 20% on the current market price for the rights issue. So 40 minus 20% we have to calculate. So 40 minus 20% will give you 32. So 32 is the subscription price. The board is willing to offer a discount of 20%, that I already read. The board is also desirous that the fall in the X rights price of the shares should be restricted to 10% of the current market price. That means they are saying this part. They are talking about this part. The fall in the current market price should not be more than 10%. That's what they are wanting. So 40 minus 10% will give you how much? 36. So what are they asking? I think you can calculate. You know, I wrote here. This is a X rights price, correct? X rights price. Okay, so basically, guys, how many variables can you say? So whatever number they are, okay, I can see 1, 2, 3, 4 and 5. Out of 5, if one is a known variable, you can always calculate that. So they have already given you what is the X rights price? They want it to be 36. Okay, the current price is 40. Okay, and the new price is 32, I feel. And they have not given, they are actually wanting you to calculate N1. Okay, tell me one thing, just be very careful. Now I do not know, before I start explaining you this further, I want to tell you something. There is something in rights issue which students do not understand at all. There is something, okay, and what is that? And that is, you know, kind of, how do I say, for this example of mine which I gave you just now, how do you say, in order to buy, the example which I gave you, not this one, which is written in the question bank, okay? Can I not say that for every one, in order to buy, can I not say like this? In order to buy one rights share, in order to buy one rights share, I need to have five rights, and rupees 80. Did you understand? Did you understand this? In order to buy one rights share, I need to have, okay. So always you are feeling that rights share means what you are going to get. So if you can interpret the way I am saying, it will be very different for you in terms of understanding. I am saying in order to buy one rights share, we need to have 5 rights and rupees 80. What are these 5 rights? Can somebody tell me? Kind of, please answer, all of you. So guys, the only job that we will do now, kind of, is to finish the topics actually. Then I've given some extra questions, as you can see. They will not take too much of time, because once you are good at your topics, I'm doing this because these questions for my students also who have bought English medium pen drives. We have English pen drives of kind of this SFM as of now, okay, in 100% English language we do have, okay. We have for regular batches for that matter, and now we will have to record for the AFM part. Hindi recording is already on because I'm taking a batch at Eldine. My live batch is going on at Eldine. It has been only 3-4 days that I've started the batch at North, okay, in Hindi medium or Hindi English mix, that is the language. So students who can understand a bit of Hindi in South India also can buy those pen drives or register to the live batches also. But students who cannot understand Hindi at all, okay, for them I'll start recording in 1 or 2 months maybe. 5 existing shares. Yes, Priyanka, thank you so much. Okay, so coming ahead here, the number of equity shares to be offered for each rights held. Can you see one thing? Can you see one thing that 5:1 means, careful, 5:1 means for every 5 shares I have, I'll get a offer, or I have a right to buy one rights share. That's how we can interpret. But if I do not know this, it is actually 1/5, 20%, okay. You can buy 20% of what you have. Are you getting this point? So basically, in order to calculate this, they are asking you to calculate this one, N1. They want you to calculate this one, N1, but I need to have N0. But I can always assume N0 as 1. Are you getting the point? For example, here, can I not assume N0 as 1, okay, and N1 as 0.2? All of you, can I not assume here that N0 is 1, okay, and N1 is 0.20? Can I not do that? The meaning remains the same. For correct, no, that means rights is like 20% of the existing number. If I'm not, like, if I'm able to convey the message, which there are few things which are very intuitive. You have to feel that. They cannot be, I can't speak, I cannot write. It has to be felt somewhere in your heart or maybe in your mind maybe. Did you understand, guys? Correct. No, we can do that. That is how they have done this question. Look at this. So rupees 40, they've just substituted and taken out the answer, and they've got 1. That means for every one share held, okay, you will get a right to buy 1 rights share. Okay. Then we have question number 2, theoretical value of right. Now, theoretical value of right means you can calculate this in 2 ways. So basically we have 3 prices. One is the S0. Wait a minute, please. These things you will not find any book actually. I can only tell you because I've struggled through these concepts on my own, and I can tell you something extra maybe between the lines. So S0, rather P0. P0 is what? MPS, the current market price. Okay. Then P1 is what? It is a subscription price. it is subscription price, then you have X rights price, okay, X rights price. So you have three prices basically in order to calculate value of a right. Okay, this is a very important calculation, because the way I started rights issue discussion, did I not say that a investor or a shareholder, not an investor, and a shareholder can choose three things. Number one, he can choose to buy, maybe like in this example, he can choose to buy for every one share held, he can choose to buy one stock at 32. He is accepting that offer. Number two, he can choose to sell those rights, and somebody else can use those rights to buy that share. So what price do you sell? That is the biggest question. That is why they ask you to calculate value of a right. And how do you calculate? I tell you. So one way is P0 minus P1, okay, divided by N0 plus N1. Careful. This is one way. So in our question, can we not write 40 minus 32 the whole divided by 1 plus 1? Okay, so how much do you get? You get 40 minus 32 the whole divided by 2. You will have to, like, this is something like photogenic memory, because exams are like right there. Okay, so you cannot be like wanting to conceptually understand everything at this moment. So we have to quickly figure out that how are we going to move. So 4, we get 4 here. There is one more way of calculating that value of a right. This is the value of a right. Value of a right. There is one more way, and that way is, can I not write X rights price? X rights price. Okay. So depends how are you calculating, minus P1 minus the whole divided by N1. Sorry, N0, not N1, N0. So just check out the calculation, tell me whether you get 4 again or not. So here guys, X rights price is how much? 36 minus 32 divided by 1 will give you again 4. So you can use either one of them, not a problem at all. You can use either this one to compute the value of a right. So be careful. Maybe I don't know what kind of questions they will frame, but you can use either one of them. So if you use, I've written here P0, P1, X rights price. If you take this adjustment, P0 minus P1, then it will be, the denominator will have old and new shares both. But if you take X rights price minus P1, then you will have only the old shares. So this is something very important you should know, because students keep on calling me and asking me, ma'am, they are using two formulas. Not two formulas, it is one and the same thing. So it starts from 40, 36, 32. 40, 36, 32. So 40 to 32 if you are doing, denominator will have both the shares. If it is 36 minus 31, then only the old number of shares. I hope you got the point. Now the third question, the total number of equity shares to be issued. Okay, so nothing, the amount that you want to raise, 12 crore divided by the subscription price 32, and you get the answer, guys. I'm sure you are sorted here. Okay, again, the next topic that we need to do is the technical analysis actually. So what is technical analysis? Quickly, you will have, see how many topics are there. Technical analysis is one topic where I need to speak a lot. Okay, then we have one more topic, valuation of non-listed company, and then I think we have a dividend distribution versus capital budgeting. So I need to talk only on these 4 topics. So maybe like I will take 15-20 minutes each, maybe 15 minutes each on these, each one, maybe 20 minutes, okay? And remaining like 4-5 questions, whatever I have given to you, okay, like extra question, they will not take too much of time. Maybe like every question will take 5-7 minutes, that's it, and we would be sorted. So whatever time we need to invest is, we have to invest on these concepts, because they are concepts. I have to give one example against every concept. So what is technical analysis? Try to listen. Analysis means trying to compute what should be the value of the stock. So basically, Priyanka, you know what happens, that this 4, okay, if you get this 4, suppose I tell you something, she has got a very good important question here. She is saying that, ma'am, can you explain what is this 4? Am I correct, Priyanka? You are wanting to know what exactly this 4 stands for, correct? So maybe if I'm like right deciphering her question, then maybe she is wanting to know this 4 stands for what, like that way, correct? So basically, if you see, Priyanka, you are a shareholder, okay, and you had a stock at the price of 40. Okay, and what will happen after the stock goes X rights? The price of the stock becomes 36. Okay, so in that scenario, the value of the right is 4. So if you are not wanting, I'll explain you like this. If you are not wanting to buy that rights offer, you can sell this right to someone else at a price of 4. So basically, if you have not subscribed and if you do not sell your rights, you are basically losing money. You are losing money. Why? The stock that you used, your wealth used to be at the price of 40. After X rights, okay, after the stock goes X rights, the stock will fall to 36. Okay, maybe like if you have 100 stocks, for example, or maybe like, yeah, maybe you have only one stock. No, it is not that. It is not that. Prerna, it is not that. So what is this? Actually, I tell you. So suppose you have 100 stocks. Assume you have 100 stocks. So 100 into 40 is the wealth of a shareholder before the rights issue was offered to everybody. Correct? So maybe like, and after that, maybe like, what example should I take? Should I take this example? Should I take the previous example? I think I should take the previous example maybe. So tell me which example. No, that is the fall in the price. That is the fall in the price of the stock that you need to get. If you are not subscribing, for example, I tell you something. I need to have one example. The previous example, can I take? I just get very excited because I want to explain very nicely to the student. This one. Okay, fine. So suppose you have one stock. Okay, you have one stock at a price of 40. Okay, your wealth is rupees 40. Now when the stock goes X rights, the price of the stock will fall to 36 naturally. So if you have not taken any action, means you did not accept the offer of buying the stock, nor did you sell your rights, you just kept yourself idle. In that case, you will have a loss of like 4 rupees. Okay, that means that 4 has to be recovered. But if at all you would have acted, okay, you would have acted, what would have happened? You would be having one more stock. Okay, so now you have 2 stocks. One stock is like that you already had, and you accepted the offer. Okay, accepting the offer means you paid 32 and bought one more stock. So now you have 2 stocks. Okay, so 2 stocks. Now after the stock goes X rights, 2 into 36 will be the price of the stock, that is 72. Okay, and 72 minus how much did you pay? How much did you pay for the stock? Tell me, how much did you pay for the stock? So now you have 2 stocks into 36. Okay, that becomes 72. How much did you pay? You paid minus 32. Okay, you get 40 again. Did you realize what happened? Because you accepted the offer, your wealth remains at 40. Because you accepted the offer. Again, start the calculation, please. Assume case 1, you accepted the offer. Okay, now you have 2 stocks. Okay, so 2 stocks at the price of 36, because the price will become 36. No, the price will become 36. So 2 stocks, one the previous stock, one you accepted the rights offer. Okay, so 2 into 36, that means the value of 2 stocks at this point of time is 72. But out of this 72, you have paid 32 to buy that rights share. Minus 32, again it becomes 40. All of you, again it becomes 40. Do you not agree? Now, case 2, I do not accept the offer of buying the stock, rather I sell my rights to someone else at a price of 4. So suppose the value of my stock is 36, and when I sell that right to someone else, he gives me 4. 36 plus 4 again becomes 40. So your wealth is not changing if you accept the offer of buying the stock or you sell the right to someone else. If you did not do either one of them, the value of the stock falls from 40 to 36, thereby you are incurring a loss of 4. I think I have explained very nicely to all of you. Now, technical analysis. So basically correct. So basically there are 2 types of analysis. What is analysis? Wanting to know what is the price at which I should buy and what is the price at which I should be selling the stock. That means how to decide that? So there are two broad models. One is called technical analysis, one is called fundamental analysis. In yesterday's lecture, in the last lecture, correct. So I don't want to, my wealth should not change because of any decision of the management. My wealth should remain at 40. Okay, so your wealth will not change if you subscribe to the share or if you sell you do some action actually. If you do not do either one of them, then definitely you would be losing by rupees 4. Okay, so two types of analysis are there. Number one is like kind of fundamental analysis, and number two is technical analysis. The previous lecture of equity, we were focusing only on fundamental analysis, where you were trying to compute the intrinsic value of the stock on the basis of the projected financials like P&L statement and cash flow statement and balance sheet and everything, depending on the book order size and the sales and everything. That is called fundamental analysis. You took various models like dividend discount model, free cash flow to the firm model and all that. That is fundamental analysis. So primarily, I am a fundamental analyst actually. Second is technical analysis. It has nothing to do with the projections and the cash flow and the balance sheet and the P&L and everything. It has nothing to do. Okay, what it focuses on only two things. Number one, the closing prices of the stock in the past, the historical closing prices and the volume behavior of the stock. Okay, most of the time the technical analyst even doesn't know what does the company do actually. So they say that the logic of the technical analysis is that human brain follows a pattern. Okay, human brain follows a pattern, and if you can identify those patterns, you would be able to predict their behavior. So on this logic, they are basically trying, on the basis of closing prices and volume behavior of the stock, they try to read the patterns. Okay, and if similar patterns are going to come in the future, they try to predict the prices of the stock. Okay, this kind of, and they develop varieties of charts on the basis of this prices and volume behavior, which has happened historical, not the future prices, the past prices actually. That is technical analysis. There are so many varieties of calculations and charts and graphs and so many things that you do in the technical analyst in order to identify such kind of patterns and then suggest the investor where to buy, where to sell. Okay, this price you should buy, this price you should sell, and all that. We don't want to get into that detail. One of the very important study in the field of technical analysis, or one of the very important tools in technical analysis, is moving averages. I tell you what is a moving average. So basically guys, if you plot your daily prices, suppose I plot 365-day closing, 365 days maybe. In a year, the stock market is open only for 250 days actually, not 365, because Saturday, Sunday and the holidays it is closed. So suppose I plot 365 days closing prices of a stock, I get something of this sort, this. I do not get, because it is affected by my daily sentiment. Okay, I'm not able to understand anything. So suppose I just give you some idea. Suppose I have prices maybe like 100 or maybe like 110, then 105 and 108 maybe, and then again 110, then 112, then 111, and so on so forth. I can have such kind of data. So the daily fluctuations doesn't help me get a fair idea about the broad direction of the stock. It doesn't allow me, because there are too many fluctuations in the stock, and the graph doesn't give me too much of a good idea or fair idea about the movement of the stock. But if I can calculate, one is called SMA, simple moving average. So it can be prepared for various maturities, like I can prepare a 5 days moving average, 10 days moving average, 15 days moving average, maybe like 3-month moving average, like that. Okay, so suppose I prepare 5 days moving average here. So how do you prepare? 100 plus 110 plus 105 plus 108 and plus 110 divide by 5 will give me 106. Okay, the 3 4 5. Okay, 106.6. Okay, then again I will leave this one and take again 5 values, 110 plus 105 plus 108 plus 110 and plus 112 divided by 5 will give me 109. Okay, then again I will leave this one and again take. So this column is called simple moving average. 5 days simple moving average I have prepared, and when I plot this particular column above this, so maybe I get fluctuations, but they are smoother. Okay, why smoother? Because I can see the direction. So maybe on one you can have multiple simple moving averages, 5 days. The as you increase the number of like those days, like instead of 5 days, if you're taking 25 days or 30 days, the kind of the daily fluctuation will get smoother and smoother. Okay, and you get a fair idea. That is called simple moving average. Okay, one is called exponential moving average. Okay, so there are two actually. Simple moving average is criticized on the fact that suppose you prepare 30 days or maybe like 60 days moving average, simple moving average. So basically you are giving equal weight to all the 60 prices that you have taken. In 60 days, the price of the stock, the sentiment of the stock can change drastically. So they are saying that more importance should be given to the latest price in comparison to the very like old prices. Like first day price and the 60th day price is getting the same importance. Okay, we do not want, if you do not want that, then what you can do, you can calculate exponential moving average, wherein you give all the importance to the latest closing price and not the past prices. That is the difference. But at this point of time, instead of explaining you the concept and everything, I am more focused on explaining you how to prepare the sum actually. Okay, then going further, two things you must know when you are doing this. Number one, when you are doing this, then basically you must not forget that you need to have two datas here. Okay, this is a question of computing exponential moving average, but without explaining SMA, I cannot explain you EMA actually. This is called exponent or alpha. Okay, so basically 2 by n plus 1. Okay, if they do not give you, and opening EMA. If this value is not given to you in the sum, then you will, for example, they say you that 5 days EMA you prepare. But in order to prepare EMA, I would need, I'll show you in the question, guys, you'll understand. I need to have opening EMA. If they have not given, then you calculate SMA and use that as a starting point. So there can be 4 situations in your question. Number one, they have not given both the datas that you need to prepare a EMA schedule. Okay, they have given you alpha, they have not given you opening. They have not given you alpha and they have given you opening, or they have given you both. So there is a possibility actually, but you should be able to solve a question with any combination for that matter. It should not bother you at all. Okay, so basically here guys, if you see this question, be careful. So they have given this question here. I think we would like just move on. So calculate exponential moving average of Sensex during the above. I think kind of recently, not very like not a very old affair for that matter. Recently, maybe 1 or 2 or 3 terms back only, they had asked question where they wanted you to calculate this one. Okay, so the formula is 2 by, guys, kind of there are many formulas with respect to that. Okay, I usually taught in the class with 2 by n, where n stands for like 5 days, so n will be 5. Okay, but the institute writes 2 by n plus 1. So please go with this formula only, don't take 2 by n, in case this is an important topic for upcoming exams, because it has been already 3-4 attempts since they asked this question, maybe 3 at least. So this topic is an important question. Calculate EMA of the Sensex during the above period. The 30 days simple moving average of the Sensex can you see this line? November 19, yes. November 19, are you sure? No, Prerna, not November 19. I think they asked after that also. After that also, sweetheart. Okay. Okay, they have given 15,000 and the exponent value. Both are given to you, and you can calculate easily even if they are not giving you. Okay, so opening, look at this. So this is how it moves. This is a schedule. How it moves. You will write the prices, whatever, careful. I am more focusing on the tactical stuff, not the conceptual stuff, as in how to do the sum. That's more important at this point, at this juncture actually. Prices are given. Just remember this kind of, most of the times what happens, when I start doing the sum, the students are able to fill in the chart very properly. Okay, but the moment they start doing on their own, they are not able to solve in the paper. The reason is that this whole schedule was prepared by me, wherein I gave these things already to you. This was already given to you by me. You never wrote this. You just kept on calculating and doing stuff. So when you start doing in the examination, you feel, okay, I was able to do in the class. Why am I not able to do here? Because this schedule was prepared by me. You are just filling the inside part, okay, the data part actually. So it is more important to remember what are the headings actually, okay. So the first heading is opening EMA, okay. So basically, can I say that this is 1 and this is 2, okay. So 14,522 minus 15,000 is given. If it was not given, you were supposed to calculate actually. Minus 478, multiply with the exponent, and this 29.4 will be adjusted to 15,000, which will give you 14,970.37, and it will keep moving like a loop actually. So if you see in this EMA, we are considering only the latest closing price actually. We are not considering the old 60 days prices, and that is why they find EMA as more scientific in comparison to the simple moving average, okay. Do you know something? You will answer my question, okay. In this, if I start doing EMA in this example of mine, my solution will start from here. Why? If I want to do EMA sum from here, my example, suppose these are the prices, then I can start. Can you see it started from here only. It has started from the first price only. But in this case, I will be able to start from here only. I will not be able to start, suppose opening EMA, if I suppose right, I will have a dash, dash, dash and dash. Why? Tell me quickly. If you can answer me that, then I'm sorted. I'll move on to the next topic. No, not like that. I do not have opening EMA, no. If I do not have opening EMA and I suppose I say 5 days EMA, then first of all I'll have to compute the first opening EMA, no. So if EMA is not given, then I will have to calculate the opening EMA, which is this one, and this will come here. This will come here. Are you getting the point? 106.6, and from here the sum will start. All of you, are you fine? Yeah, there was no SMA required. I mean, since they gave you started from here only. But if the EMA, opening EMA is not given to you, then how do I start the question? How do I do the question? That means I will have to first compute 5 days SMA, and that computed 5 days SMA will behave like the first EMA. So any which ways you have to start from the fifth data point or fifth day price only. Did you get the point, all of you guys? You need to answer, guys, all of you. Everybody, please answer. I need to go ahead, guys. You interact less actually. Please interact. A bit of it will help me. Where are other people today? Okay, I'll continue. Valuation of the non-listed organization. Valuation of non-listed organization. Now, what happens? There are, suppose I am a company, I am already correct. Okay, thank you, Viru. So suppose I am a company, okay, and I am already into some kind of business, and I am wanting to start some new business which is not related to my current business. Okay. Okay, and I ask all of you, okay, I ask all of you, like, all the students, will you invest in my company? Then you ask, ma'am, what is the kind of return that you will give us? Maybe what return will you give us? That means you are asking me, if we people give you equity, that means if Viru gives me equity, then what is the kind of return I will be able to pay him? That is the question actually. Okay, so I also do not know because I have not done that business before. Okay, so if in order to value such kind of companies where we do not know, okay, we do not know what is the kind of return, because I have not done that business. In that scenario, what we can do, we can identify few proxies actually. Okay, we can identify few proxies, and with the help of the proxies we do certain calculations. I'll show you that. That concept is so important, guys. Look at this. Yeah, actually, very less people are attending the lectures on a live basis. It was a second time effort for me to come for the lectures actually, because I already had a run of 15-20 days for that matter. So I thought that people would be really like kind of, though they are watching in recording, I can see there are a lot of people watching in recording, but it will make me happier if you can come for live, because it takes some effort, and if you're there, it makes me happy. So any which ways you have to watch. So watch along with me only if possible. That's what I can say. Which sum is not there in the sheet? This question, 11 number question is there in the sheet, no? So what time should I do, Pooja? Tell me what time should we do then? Tell me, I mean suggest me a time then. Because it is now, see, if only 5-6 people are there, then running the whole batch for 15 days, it becomes difficult for the teacher also, because it's a 3-hour slot. What time do you want, Pooja? Thank you, Priyanka, for coming. Thank you so much. It is there in the sheet. Why will not? Because I am using the same sheet actually. Morning time was better. So tell me what time. What time do you want the batch to be run? Is it, do you want it to be like there maybe 11 o'clock or something? But it is, we change the time only because of that. So tell me a time. Maybe can we do at 4 o'clock or something? Because see, morning I have lectures. Morning I cannot take. I already have CA final lectures, a batch running actually. So I will not be able to take in the early morning. 10 to 1. That is what. So let's stick to the time then. Let's stick to what else can we do? Any which ways, the timing originally that we kept was 4 o'clock to 9 o'clock, 5 hours daily, correct? I can do 2 to 5, I don't mind. If you want 2 to 5, I can do 2 to 5, not a problem at all. That's convenient for me. I can manage that 2 to 5. Are you there for 2 to 5? Yeah, because of the Visarjan actually, there will be too much of noise. There would be noise in my case also. We will have to change timings any which ways, because there would be Visarjan thing happening. That is there. So let's finish today. Let's not waste time. Let's finish today's portion. It will not take too much of time. So maybe we can take, I can take in the afternoon, not a problem, like 4 to 7 or maybe something of that sort. So guys, all of you, maybe like, can we discuss this on the group maybe? Yeah, there is too much of noise actually. So it will be, the Visarjan will be there for the next 10 days non-stop. I told you on the first day also, there would be a lot of noise, because once the Visarjan starts, it is too much of a noise. Maybe we'll have to prepone it a bit. So tell me the time, what time should I do? Let's block on one time. Yeah, we should carry forward with our lectures. Correct. So somebody is speaking which is who never came and had a doubt also. Okay, who is it? Balwan tax station. God, who are you? Okay, continue then. We lost the track basically. Now we can discuss on the group. Relax. So who are you? What is your name? Your name cannot be Balwan tax station, right? So valuation of non-listed company. Okay, now here. So two things I want to tell you. Okay, one thing is that any business that we run, okay, or maybe like kind of I can start with something easier for you, like this is a balance sheet. Okay, so this is equity. Where do you stay, Deepak? Equity, debt, and these are assets. So this is BE, this is beta of debt, and this is beta of assets. Okay, and where do you stay, Deepak? I mean, which city do you stay? Beta of liability and beta of asset. So what is the logic of this? This means, guys, this concept is so damn important. Any chapter, IFM, Forex, merger and acquisitions, anywhere they can ask this topic, asset beta concept. We call it asset beta. Okay, asset beta concept, or we can also call this as project beta concept. Thank you for joining us, Deepak. Project beta concept. Okay, this is such a important, I don't know how many of you have ever thought or learned, or somebody has told you about this, that this is such an important concept. You will not be able to figure out only that what are they trying to calculate, unless and until you have a very strong, see, the question that I have given to you is not an ICI question. We used to solve this question in capital budgeting in 2018 and before, when we used to have capital budgeting in the strategic financial management paper actually. Now from 18 till now it was not there. Again from May 24 they have included the capital budgeting. But the concept can be applied anywhere, capital budgeting, equity, IFM, Forex, merger, anywhere. Wherever you want to know that what is the rate at which you should discount your cash flows. Okay, you will, how do you know? You will identify few proxies. For example, I want to start a business of like what? Biscuit. I give the same example in the class because that is easy for me. Okay. So I do not know what is the rate at which I should be discounting my cash flows generated from the biscuit business. So maybe I identify 3 proxies which are look alike. They are into the same business. Maybe size and all are also same for the sake of it. Example in the class, Sunfeast, Parle-G, Britannia. Okay. So in order to compute the present value of the cash flow, discount the cash flows and compute the NPV, I need to have a discounting factor. What are the variables that you need to compute KC? KC is the discounting factor for the cash flows. WD, KD, 1 minus T plus WEK. That means you need to know how much money would be from the debt side, how much money would be invested from the equity side, what will be the tax rate, okay, and what will be the KD, what will be the KE. I tell you something, what is the proportion of the debt and equity is not a very like something to discuss. Usually we follow industry standards, or it can be very personal to some company. So whatever money you are able to arrange in the form of debt or equity, so depending on that WD and WE would be calculated. Okay, number 1. Number 2, then tax rate is something we cannot decide, it comes from outside. Now KD, what rate I borrow money from the bank, I cannot decide. The bank will decide and tell me, okay, depending on the risk of your cash flows, I can give you money in the form of the debt at this rate. So what is left is only KE. And in KE also we follow CAPM model, that is RF plus RM minus RF into beta. RFRM, again, I do not decide. RM is the stock market index return. RF is the treasury bill rate of return of the government of India, if I am talking about India. The only thing that we do not know that what is the beta of new business, and because of that beta, you cannot calculate KC, and if you do not have KC, you cannot calculate the present value of the cash flows and cannot compute the NPV, and you would not be able to know whether you should invest in the project or not. Agree or not? I would want an answer from everybody. Yes, I know Pataudi place. Yes. So you stay there actually, basically. So nice of you. Acha, nearby. Okay, agree. Now, if you see this, you can see that equity has got beta of equity, debt beta BD. This is a very important discussion actually, something. If they do not give you with BD, usually beta of the debt will be 0. Okay, usually the beta of the debt is 0. Why? The issuer of the debt doesn't have any risk because he knows he has to pay that amount only. Okay, and the person who takes money, okay, or gives money or takes money, both people do not have any risk, and that is why the debt of the beta, the risk of the debt beta basically, or the risk of the debt is 0. Only if they do not give you, but there is a possibility that they might give you the beta. I will give you one question while doing portfolio management, where in the question they have mentioned BD, the debt beta actually. In that case, you cannot assume debt beta to be 0. See, nothing in this world has got a risk of 0. Nothing in this world. This is too theoretical, but yeah, for the sake of it, we are doing some theory part, we can assume debt beta to be 0. But yeah, in comparison to equity, definitely debt does not have any risk, neither to the issuer nor to the investor. Do you understand one thing? If you are wise enough, when equity people invest money into the company, when debt people invest money into the company, they know that they are giving money for biscuit business. Okay, and hence the risk perception, that means the money that they have given should be going into the investment and buying of the assets which would be used to carry on biscuit business, and hence they should be in balance. That means to say the risk perceived by the stakeholders and the risk of the assets in which their money has gone should be same. So at equilibrium, BL should be equal to beta of asset. Can I break it? So D by D plus E, okay, into beta of debt plus E divided by D plus E, okay, into beta of equity should be equal to beta of asset. Okay, now as I told you that usually beta of debt will be equal to 0. Okay, so this whole thing becomes 0. We are only left with E by D plus E into beta of equity should be equal to beta of asset. Okay, now beta of equity will be equal to beta of asset, brackets open. If you take this side, D plus E by E. Okay, again, I am sorry because I am taking some time, but if I do not show you, just mug up. You are not required to mug up anything in this world. Okay, then here this will be 1 plus D by E. Okay, and again, since debt will bring you tax benefit, okay, the debt we are talking about, see, this is Modi-Jelani Miller thing actually here. So we are not wanting to get into too much of detailing, but yeah, there is some midway, between derivation and mugging of the formula. There is something called midway. I can still understand what exactly this is, right? So 1 plus D by E into 1 minus T, that is a tax benefit, and we are done, guys. Okay, so this is the formula for asset beta, project beta. What does it stand for? I'll tell you that. Now, a equity shareholder when invests in a company faces two kinds of risk. One is called business risk, one is called financial risk. Business risk is something he cannot control, and all the players within the industry will have similar business risk, like risk of raw material, risk of suppliers, risk of customers, and many more things, government risk, tax risk, whatever it is. So if you are into the industry, if I am a player in the coaching industry of CA Final or CA Inter or CFA, there are some inherent risks that I will have to bear. Nobody can avoid that. Okay, then The second category of risk that will come to my company is because of the leveraging part, how much debt I have taken. So they say that the business risk for everyone in the industry will remain approximately the same. Okay, but the financial risk can be unique to each one of them. Maybe like somebody takes, suppose everybody is employing 500 crore of debt. Somebody will take 300 equity, 200 debt. Somebody can take 200 of equity and 300 debt. That depends. That we are not like too much bothered, because that will be always specified in the question. Now, this whole, that means risk of equity shareholder, BE, will be a combination of beta of asset, that is called business risk, and this will be again financial risk measured by, are you fine all of you guys? Okay, so what you are maybe not getting what exactly she is trying to do. So in a question wherein you want to value a company, okay, you want to value a company which is not listed in the market, then what would you do? You will identify proxies from the market who are look alike, okay, and then you will calculate beta of a set for all those proxies. Like for in my example, Parle-G, Sunfeast and Britannia, I will calculate BA. Okay, so why BA? Because I am in the same industry. How would you do that? So basically they will give you BE in the question for all the three companies, and they will also give you this data for all the three companies. So when you divide BE with that bracket on the right hand side, what you will get is BA. Okay, that means you have BA of Parle-G, BA of Sunfeast, BA of Britannia. 3 BAs are there. You take a simple average. You take a simple average if they have not mentioned anything again. If there are 3 companies and you look more alike to one particular company, you can give a higher weight to that, but that has to be mentioned in the question. Okay, so if nothing is given, take a simple average. What you get is the asset beta of the biscuit industry. Now you got the BA. Now what you will do, you will use this computed beta, use your own D by E and your own effective tax rate to compute BA. Got it? Yes or no? And then apply RFRM using CAPM model, you get your KE. Okay, rest of the data would be always given to you in the question. Compute KC, discount your cash flows, compute NPV, and you are sorted. So this is valuation of an unlisted company. Okay, maybe I can share this sheet with you in on the group basically. Don't worry about that. So X Limited presently, now you will not take time to understand guys. Okay, X Limited presently operates but risk, usually we assume, Prerna, that debt does not have risk. Usually we assume debt does not have risk. If it is there, they will mention in the question. In that case, you cannot take 0. X Limited presently operates, okay, in a cement industry. I want to change the color actually. With a debt equity ratio of 2:1, its cost of debt and equity are 13 and 17% respectively. It is subject to Priyanka, debt will get you tax benefit. Don't get into the derivation, Priyanka. You will face problems because it will be sluggish then. Okay, 1 minus T is why, because this debt, this is the debt I am talking about, is a perpetual debt. Okay, so if you maybe like if you get me into that derivation partner, you will get sluggish in the calculations actually. So basically only one thing you have to understand, that debt will get you tax benefit, interest will get you tax benefit basically. So maybe kind of like suppose present value of interest. Okay, so suppose like kind of if there is a company, so I avoid all this because then it will become very lengthy. We cannot do that part, right? We need to avoid that, getting into the intricate calculations actually. So every year you pay interest, every year you pay interest, I and I. Okay, and I have got a very bad habit. If the question is asked by a student, I just cannot move ahead. Okay, so every year what will happen? Every year what will happen? You pay I. Okay, what you pay is I, and every year what is being paid? Maybe I can say like this. Maybe 1 minus T every year, because you pay I, but you get a tax benefit on that. So suppose you pay 10 and the tax percent is 30%, then effectively you are paying 7 only. You are not paying 10. So everywhere 1 minus T. Okay, 1 minus T and so on everywhere. So if I take a PV of this cash flow, perpetual cash flow, D1 by K sort, okay, then can I write I, okay, 1 minus I by KD, and this is 1 minus T, okay. So if I bifurcate this I by KD, okay, and this is 1 minus T, what will happen? This I by KD, okay, I by KD will become debt amount. So debt into 1 minus T. Did you get now? So that is how it is like derived actually. So we are not getting into that. Even the ICI doesn't bother about that. Okay, now, so it is subject rate of 30%. It feels that the growth rate in the cement business is going to be low or moderate. Similar example, it therefore decides to strategically diversify into new emerging biotech sector. The projected cash flows from the long-term funds point of view. Did you understand, Priyanka, now? Okay, for this biotech projects are shown below. Okay, so they are wanting to they are into cement business now, and they are wanting to diversify in the biotechnology business. They've given guys the cash flows of the biotechnology business. These are the cash flows, and you are wanting to have a discounting factor for these cash flows. Okay, so they have given you debt equity ratio of 3:1. That means 3 by 4 and 1 by 4. I told you yesterday that debt would be by the rate KD is also given, and tax rate we will take from here 30%. Okay, but we do not have how to calculate KE. That is the biggest question here. They've given you RF and they've given you RM minus RF. Same example the way I did for the I explained you actually. So these are the two proxies, Bharat Biotech and Granular Biotech. Look at this, how are they going to do? So D by E 3:1, KD 16%. In order to compute NPV, we require KC. I've written everything there. So KC is WD KD 1 minus T and WE KE. WD will be 3 by 4 and WE will be 1 by 4. Okay, then KD 16% and tax is 30%. Okay, we require KE for computing KC using CAPM model, but I have this one, I need beta. So this deleveraging of proxy beta, did you not see the data that they have given you for Bharat Biotech? They have given you equity beta 2.2. So 2.2 will come in the answer, and 1 plus 2.5 by 1 minus 35% bracket close. You can solve for BA. Look at this. So you can using this formula, you solve for BA, you get 0.84. For granular, you do the same thing, you get 0.51. They've given you weights above. Okay, if your company looks more like Bharat Biotech actually, then they have given a higher weight, 70% to the first company and 30% to the another company. Average BA of the industry, of the biotech business, they are saying. Now, use that 0.74 here, use 3 by 1, okay, the debt equity ratio that this X Limited is going to apply for the biotech business, and 30% you get BE, use RF RM to compute KE, KC, discounting, and then you are sorted. There is nothing in the question. I have explained you how exactly, I told you the core part from where the question is coming actually. So this could be like there is a question in the merger and acquisition that is called KLM Limited. So you will see that proxy, kind of proxy company data they have given you. KLM Limited. The first question that they ask in that question was asked in May 10 paper actually. The first question that they ask is that compute KE, okay, compute KE for what? KLM. So you will have to use not KLM, I think another company. So you will have to use the proxy beta, deleverage that proxy BE. Deleveraging means removing that bracket part from the BE, okay, and compute BA, apply that BA to your own company valuation. That is called deleveraging and then releveraging. Moving on to the next topic, dividend distribution versus capital budgeting. Okay, now this is a very interesting question actually. So Rahim Enterprises is a manufacturer and exporter of woolen garments to European countries. Their business is expanding day by day in the previous financial year. So basically guys, what is this topic all about? I tell you the concept. So maybe like assume that a company is already running, okay, it is generating good amount of cash flows, and it wants to decide, it is contemplating basically that whether it should use this extra money or maybe use this money in order to distribute dividends, or it should be going for putting up a project. Okay, so whatever decision the management takes, whether it is about a bonus issue, we have won some. I know that. Okay, so basically guys, if you see Harsha, that KLM sum, they have done the calculation similarly, same way that I have done here, because there is only one way of doing this calculation, and I think this calculation has been done by Modigliani Miller has derived this model basically. So again, coming to this, so anything the management does, whether it is about dividend distribution or bonus or rights or new project or merger, it has to ensure that it should always be targeting itself towards maximizing the wealth of the shareholders. The shareholders say that if you cannot increase our wealth, please do not take any decision that will decrease our wealth. Okay, so dividend distribution versus capital budgeting, on the face of it you will feel that it is very weird. How are you comparing at all? So the assumption theoretically is that if you distribute dividends, it will not change the wealth of the shareholders at all. It will remain the same. How? Suppose if a company is trading at a price of 110, and if the company distributes a dividend of ₹10, then post dividend, the wealth of the shareholder will still remain to 110, because the investor will get a dividend of 10 and the stock price will become X dividend at 100. It does not change, neither it increases nor it decreases theoretically, guys. But if you put up a project, there is a possibility that you generate positive NPV. So that NPV will add to the reserves of the company. It adds directly to the wealth of the shareholders. So if the project gives you positive NPV, it will add up to the wealth of the shareholders and thereby increasing the price of the stock. That means you are increasing the wealth of the shareholders in real terms. But if the project gives you negative NPV, then the price of the stock will fall down, because that negative NPV will be adjusted to the reserves of the existing reserves of the company. That will bring the book value down, and as a result of that, the market value of the price will also go down. So you have to, for the sake of dividend part, you are not supposed to do anything, because we know, okay, the wealth will not change. But you are supposed to provide a solution with respect to the capital budgeting part. There are two questions in this category. One is this Rahim Enterprises. There is one more question. Okay, so maybe like if I do this question, you should be able to understand that part also. Rahim Enterprises is a manufacturer and exporter of woolen garments to European countries. Their business is expanding day by day, and in the previous financial year, the company has registered I just lost my sentence. Where is that? Has registered a 25% growth. No, it started already. The company is in the process of considering a new investment project. It is an all equity financed company with 10 lakh equity shares of face value ₹50 per share. It is an all equity financed company with, this is important, face value ₹50 per share. Okay. The current issue price of this share is 125 ex dividend. Okay. Annual earnings are ₹25 per share. This is EPS, guys. Okay. And in the absence of new investment will remain constant in perpetuity. All earnings are distributed at present. A new investment is available which will cost 1,75,000. So if EPS is 25, use your calci please. 25 into 10 lakh shares, that means the PAT of the company is around how much? 250 lakhs. Out of 250 lakhs, they are wanting to invest 175 lakhs. Okay. So minus 175 lakhs, the company would be left out with only 75 lakhs. Okay. For some years. In 1 year's time, and will produce annual cash inflows thereafter of ₹50 lakhs. That means only 1 year the dividend part would be reduced. Don't worry, relax. I'll help you out on that. And I'll give you two solutions to this question. So once I do this, when I do the second solution, the alternative one, you would be completely sorted in the category. You don't have to worry about that. Analyze the effect of the new project on dividend payments and the share price. Okay. Now, guys, first of all, I can teach you this concept, this sum only with the help of the steps. You will be able to get the whole question by the end of the solution actually. So in order to, you are basically wanting to decide whether I should go ahead with the project or not. What will be the base of decision? The base of the decision would be whether you are getting a positive NPV or not. So when I say NPV, you would require a discounting factor. And they said that it is an all equity company. So KC will be equal to KE. Okay. They have given you some data here, guys. You can use that data to compute KE. 25 is the 25 is the basically EPS, okay, and price is 125. Yes, price, you get 20% is the answer. Now current earnings they calculated. So basically what are they saying in the question? If I draw a timeline here, they are saying that here 0, 1, then 2, then 3, dash dash dash, and perpetuity. Okay, this is how it is working. So here you will invest. Here you will invest. How much are you going to invest? 125 lakhs, I think. No, 175 lakhs. So 175 lakhs you will invest. And because of that, your dividend will get reduced to 75 lakhs. Okay. Now, here guys, look at this. Okay, and from here, what is earning? 50 lakhs, 50, 50, 50, 50, 50, 50. But only 1 year your dividend will be affected. Okay, you are distributing a dividend of, you know something, all people, why did we use this one and did not use the growth model, the constant growth model? Because they said that all the money is being distributed, 100% payout company, 100% payout, and that is why we did not use D1 by KE minus GC or that formula. Rather we took dividend by price or D1 by KE formula actually. If you want to ask me, why did we use this formula? So they said that they are distributing all the dividends. Yesterday I explained you what is the impact of distributing all the dividends, correct? So only 1 year your dividends would be affected because you need to invest that money for the project. And first year also you will be having some dividend, not that you are not going to have some dividends, but 75 lakhs. From next year onwards, you know something, you will be having 50 from the project, and plus this 250 will also get free. Okay, so from here onwards, are you able to understand guys? From here onwards, this will be the cash flow pattern. So how does this go? So basically, can we not write here? Can we not write? Okay, so on the first year, the price of the stock, the first year 7.5 is the dividend that I will get. They have taken 1.20 discounting wise, and then they did D1 by KE, D1 by K. Can you not see that? That means standing here, they did D1 by K. 250 plus 50 is 300 lakhs. 300 lakhs divided by 10 lakhs of shares will give you 30 rupees. And this is what is 30 rupees divided by 0.2. But the answer will stand here. If you are calculating, this is your suppose D1. Okay, if you do D1 by K, then you will stand here with the value. And hence, they have provided one discounting factor. Did you understand guys? So basically what is happening, that on a timeline 0, 1, 2, 3 and perpetuity, here you would be able to pay a dividend of 7.5, and from here lifelong you are going to pay 30, nothing else. So basically 7.5 divided by 1.2, 30 divided by 0.2, okay, you get a value here, and then discount by 1 year, bring it here, total it up, and you get 131.25 per share. Are you fine all of you? I can solve this sum by one more method I remember. I know what is that method? I'll show you. So can I write P0 is equal to minus 175 lakhs, okay, the whole divided by 1.20, and plus 50 lakhs, the whole divided by 0.2, okay, and this into 1 by 1.20. I'll show you something. So minus 175 lakhs, okay, divided by 1.2 gives me 1458 33, how many 3? 33.33, correct? And plus 50 lakhs divided by 0.2, again divided by 1.2 gives me 208, this is minus 208 5 3s, 33333.33, okay, fine, minus 1458, I get 62 lakh 50,000, I get 62 lakh 50,000. This is not P, this is NPV, this is your NPV, okay. Okay, 62 lakh 50,000 divided by 10 lakhs, okay, that is 6.25. So per share the share of every shareholder in this NPV is 6.25 per share. What is the current price? Current price is 125. So 125 plus 6.25 will give you 131.25. Did you not get the same answer, all of you? Yes, tell me please, all of you got, did you understand what I do? So choose one method and go ahead, you are going to get any which way is the same answer, not a problem at all. Yes guys? I am moving ahead now. Okay, question number 1 from the extra questions. I will not take more than I think half an hour, or maybe like 9 o'clock we should be able to wind up, because the questions are really easy. Got it now everybody? So use one, because you know I told, did I tell you this? So one day one student called me and told me, ma'am, there are 2 questions in the book, okay, and they look very similar, but yet the method is very different. Kids will not be able to contemplate so much, no, maybe. So if you see, the methods are very different, okay. So I also was wondering, why did they give 2 methods? Then I tried this method on this question and that method on the first question, and I found the same answer, okay, like that. So Mr. A is holding 1000 shares. So this is an important question again from the exam point of view. Mr. A is holding 1000 shares of face value of rupees 100 each of MS ABC. He wants to hold these shares for long term and have no intention to sell. Okay. On January, this concept is of like, you know, kind of, let me read the question, I'll explain you. On 1st January 2020, MS XYZ Limited has made short sales of MS ABC Limited shares and approached Mr. A to lend his shares under stock lending scheme. Look at this. So basically, suppose I am a long-term investor, okay? I am a long-term investor, then, and you are a trader in the market, okay? So are you aware of the fact that you might be willing to short sell? What is short selling? You are selling a stock which you do not own only. So you can borrow that stock from me in my demat account. There is some institution called the Stock Holding Corporation of India, SSCI, and this work is this is done very professionally and very formally actually. So just listen the small concept part which is like linked to this question. So I am a long term investor. I am not wanting to sell my stock in the near term, okay? And you are a trader. You feel the stock will go down. Which stock? The one I hold. You can borrow the stock from me, okay? You can borrow the stock from me, sell in the market, okay, at a higher price, and since you feel that the stock price will go down, and you buy back that stock again and give the stock back to me. This is done a lot in the market. Anybody who is holding a stock for the long term perspective, they can earn extra return by lending the stocks to some short seller actually, okay? The question is all about that. Mr. A, now you are able to understand. So there are a few calculations which are associated with this kind of activities actually. Mr. A is holding 1000 shares of face value of rupees 100 each of MSMBC Limited. He wants to hold these shares for long term and have no intention to sell. Can you relate with this data? On 1st January 2020, MSXYZ, this is the guy who wants to short sell, correct? Has made short sales of MSABC Limited, the same stock which Mr. A is holding, and approached Mr. A to lend his shares under stock lending scheme with following terms: shares to be borrowed for 3 months from 1/1/2020 to 31/3/2020. Okay, now give me a second please. Okay. Now, so basically they say that lending charges, fees are 1% to be paid every month on the closing price of the stock quoted in the stock exchange. Okay. Bank guarantee will be provided as collateral for the value. Naturally, guys, we do not know whether the guy will be able to deliver the stock back to me or not. So we need a bank guarantee. That means the bank will take a guarantee on the short seller's behalf. Okay. Okay, now, and for that also he has to pay. The bank will not give guarantee just for the sake of it. You need to pay something for that. So you can imagine what kind of money the short seller is wanting to pay just to have that stock. Okay. Now, cost of the bank guarantee is 8% per annum. When you see the solution, you will be completely sorted. The ABC Limited declared a dividend of 25%. The face value of the stock is given to you, that is 100. So 25 rupees. Now look at this. Look at the question actually. The share price, you need to answer me one question here. In which situation this short seller will gain? Scenario 1 or scenario 2? He short sold the stock. Okay, at a price of 1000. Which scenario they would benefit? Tell me. He short sold the stock at a price of 1000 actually. So in which scenario 1 will he benefit or scenario 2 will he benefit? The short seller I am talking. Tell me. Okay, I move ahead then. Okay, you are required to find out earnings of Mr. A through lending scheme in both the scenarios. Okay, so Mr. A will earn what? Lending fee of 1%. So guys, if the price turns out to be 1020, then it will be 1% of 1020. No. Piyush, no. Because he has sold at 1000, now he needs to buy. And in order to get a benefit, the price has to go down. No. Scenario 2. The short seller has sold the stock at 1000. If you want him to earn money, the next leg of the transaction would be to buy the stock. Should he buy the stock at a higher price? You are answering 1 because you thought he has bought the stock. He has not bought the stock. He has sold the stock actually. So if he has sold the stock, then he will have to buy now. So lower the price, the better will be for him. So the lending, they are asking you to calculate what will be the earning of Mr. A. Look at this. So he will earn 1% on the closing prices. Scenario 1, they have taken the values. Scenario 2 and scenario 2. And 3, lending fees 1% every month. Okay, so 3 times he is getting. So the earning from lending, okay, is this much per share. Okay, per share in 3 months. Total number of shares 1000. You get 31,100. Then again, total earnings of Mr. A during this period. What are they asking you? They are asking to calculate what will be the total earnings of Mr. A. Who is Mr. A? The guy who has lent the stock. Okay. So he will earn this 31.10 per share in scenario 1 because that percentage of 1% is applicable not for the whole 3 months. Every month he has to receive. The short seller XYZ has to pay this amount every month. So 1 month, 1 month and 1 month. 3 months total is 31.10 in scenario 1 and 28.80 in scenario 2. Okay, then dividend 25 he will receive. Total earnings will be 56. How to 56 guys? A plus B. So 31.1 plus 25 will give you 56. Okay, multiply with the number of shares, you get 56,100 in a span of 3 months. This is extra money that you earn. But 25 is not really like 25 he would have earned any which ways. So I would not consider 25 as his extra income. His extra income is only 31,100. But the question is how much is he earning in these 3 months? So in these 3 months, he is earning money with the help of that lending cost of 1% or lending return of 1% and plus the dividend that he has received. Okay. Then profit or loss of XYZ. So guys, don't you see that gain on the shortening of the shares? So 1050, look at this. He will wind up at this price. Were you thinking that he will do thrice? No. He he short sold at 1000. After 3 months, he will buy it back. So if scenario 1 prevails, he will have to buy back at 1050, a loss of 50. Okay, I got it. Is it visible now? Is it visible now? I think it is visible now. Okay, so earnings of cost of XYZ would be the closing. So he lost per share of 50 if the prices turn out to be this, and he will earn 60 if the prices are like correct. Then lending fees paid 31.1, okay, and the bank guarantee charges are 8%. From how did you calculate this 20? How did you calculate? 1000 is the stock price at which he sold. 1000 into 8% into 3 by 12. Do it. So 1000 into 8% into 3 divided by 12, if you do 20. So these are the charges that he has to pay. So 101.10. So if the stock prices, he short sold at 1000, in order to earn, the prices have to go down. So if scenario 1 prevails, he will make a loss of 101.10 per share multiplied with 1000 shares he sold. This is his total loss, correct? Yes. And if the prices are scenario 2, then he will gain 11.2 multiplied with 1000, he will earn a profit of 11,200. This is an important sum, guys. And believe me, if you do not practice in writing this question, you are definitely going to goof up. You will not be able to replicate this answer in the exam without practice. It is just not possible. So please write this solution at least once or twice so that this question doesn't have any understanding problem, because it is very simple. Once you understand short selling and stock lending, are you getting my point? Two things. If you understand what is short selling and what is stock lending, then this question doesn't have any complex feature as such. The only thing that you would miss out is the presentation of the sum. Okay, so you know what is short selling. If you're a trader and if you think the stock price will go down, you can sell the stock, okay, at a higher price and then buy it later if it goes down. If it goes up contrary to your price belief, then you're going to make loss like scenario 1. And if you understand stock lending, then you would be able to understand, okay, if there is someone who is lending the stock, because you need to, if you want to sell, you need to have stocks in your hands. You do not have, so you borrow from someone. Correct. You need to write, guys. If you do not write, you will not be able to perform on the paper. So you have to behave like a machine in the examination hall. Then, guys, you know what? I have put one question, not this one immediately. This is very easy any which ways. But I've taken some new variety actually, which is not there in my book at this point of time. The new book that we have done for the batch that has started on 15th of September at Aldine in Hindi English mix for May 24 up to May 26. Okay, in that book, everything has been incorporated. So I incorporated these questions in my fast track, assuming that if there is some student of mine who's attending the batch, then these questions will be taken care of. NM Limited is aspiring, though all of you are mine, I am not distinguishing like that, but yeah, who have bought classes with us, so like that. So NM Limited is aspiring to enter the capital market in 3 years, okay, time. The board wants to attain a target price of 70 for its shares at the end of 3 years. Careful. The present value of the shares is 52.03. The dividend is expected to grow at the rate of 15% for the next 3 years. NML uses dividend growth model. The required, very easy. You cannot have an easier question than this. What are you supposed to calculate? You know what are you supposed to calculate? You are supposed to calculate, I think, the D0, the D value. Okay, so you can just like it. We don't need to write such complicated equations actually. We can do it very simple. Can I not write 52 is equal to D01 plus G, okay, and that is 15% actually. So yeah, so D0 is 1.15 divided by, so do I have G or something? No, we do not have G also basically. We do not have G also. Correct? No, guys? We do not have G also. What do you say? Do you have G? Both are 15% or what? I got confused also. The present value of the shares, yeah, both are. That is why I'm just assuming that why is it coming same? Because one point which I'm thinking is that without, we cannot solve two unknown variables in one equation for that matter. It is not possible to do that. Okay. So they have given 15 as growth and 15 as discounting factor. Yes, 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 yes. So maybe like, can I write here? So D0, we are supposed to solve this actually, this one. Look at this, how guys are like. Can you listen that? Correct, correct. I got it, I got it. I did not notice that data actually. 3 by 1.15 raised to the power 3. And what is the price? They told some price here, if I am not wrong. That price was 70. So 70 divided by 1.15 raised to the power 3. Solve it. You will get the answer. Why not? So basically guys, you know, kind of everywhere it will get cancelled. So how do you solve it? So can I not write 70? I get, okay, 46.03 I get. So 52.03, it is not 52, it is 52.03. Okay, give me a second. 52 point, if the questions are easier, you tend to commit more mistakes. 52.03, I get 6. Okay, so if you take 6 here, so rupees 6 here and 3 D zeros. Why? Because this and this will get cancelled, cancel, cancel, cancel. Okay, and just solve for D0, you'll get 2. And what is there in the question? Nothing. Question number 3. SM Limited has a market capitalization. This time the first question of the compulsory actually was, I think, this one only. The first question of the compulsory. So this is something, yeah, it's easy question. SM Limited has a market capitalization of 3000 crores and the current earnings per share is 200. Very important information. With a PE ratio of 15 times basically. The board of directors is considering a proposal to buy back 20% of the shares at a premium which can be supported by the financials of the company. Very important line. Okay. So looking at the data, whatever I could see till now, the market cap is 3000. Careful guys. Okay. The market cap, the total market value of the equity is 3000 and they've also given you EPS and PE ratio. Okay. So if I multiply 15 with 200, I get market price per share. Okay, so 3000 crore divided by 3000 will give me, okay, that gives me how many shares? Tell me please. 1 crore shares. What you get is 1 crore shares and they're wanting to buy back 20% of the shares. That means 20 lakh shares are planned to be bought back. The remaining shares will be 80 lakhs. Till here I could only understand this much. Going further, I will get more data. I'll be able to do more analysis actually. The board expects post buyback market price per share 3057. The board says that post buyback, correct, post buyback price should be 3057. Okay. If you are able to understand in this kind of questions, the PE ratio will always be kept constant. Otherwise, you cannot solve the question. So if I divide 3057 with 15, I will get the new EPS. Agree with all of you? 3057 divided by 15, if I do, I get 203.8. Okay. So that means to say existing number of shares, existing is 1 CR. Okay. New would be 80 lakhs. Bought back, obviously, bought back. When you write, your brain registers better. Okay. So 203.8. Agree all of you? 203.8 will be the new EPS. Okay. Should I multiply 203.8 with 80 or 1 crore? Please answer. 203.8 is the post buyback EPS. I should multiply 203.8 with 1 crore or 80 lakhs in order to get PAT post buyback. Tell me. 0.8 crore, 0.8 crore. The question is that, now I think we have already sorted here, okay. Then they are saying the company proposes to fund the buyback, okay, fund the buyback by availing 8%, okay, 8% bank loan since available resources are committed for expansion. It's a very easy question, guys, okay. Yes, very good. The interest amount which can be paid for availing the bank, what is that? Bank loan, okay. The interest amount which can be paid for availing the bank loan. Guys, this is a back calculation sum actually. What will you do? So current EPS is 200, okay. So 200 into how many shares? 1 CR. So basically your PAT is 200 crore. Agree all of you? So current PAT, they've given also. Why should we, like, but if you want to go through that, so current PAT is equal to current PAT is 200 crore, okay. I need to make pre-tax PAT, pre-tax earning basically, pre-tax profits, or we can say pre-tax profits will be 200 divided by 0.7, tax rate is given to you, divided by 0.7 gives me 285.714 crore. Agree all of you? Now, what was the new EPS? You told me na 203.8. So 203.8 into 80 lakhs. I get something, divide by 1 crore. Okay, I get 163.04 is the new PAT. So new PAT will be 163.04 crore. Okay, and pre-tax will be divided by 0.7, that gives me 232.914 crore. Can you not see something here, guys, that there is a difference between the two? Okay, the difference is because of the interest component. So minus, maybe I can write down 285.714 minus 232.914 gives me 52.8 crore. Agree all of you? 52.8 crore, all of you. So 52.8 crore is an interest component which is creating a difference between the two. That's correct. Look at this. 52.8 crore. They have given in lakhs. We are doing in crores. And 52.8 crore is an interest component. Okay. And the 8% is your rate. That means if I divide this 52.8 with 0.08, I should get the loan value. That is 660 crore. That is 660 crore of loan you have to raise. Okay, you are going to raise 660 crore of loan. Guys, if I divide 660 crore, okay, with what? 20 lakh shares, I will be able to get the price at which buyback has happened into divided by 20 lakhs. I get 3300. 3300 is the buyback price. Since current price is 3000 and the buyback price is 3300, that means you are going to pay a premium of 10%, 300 of 3000. Are you fine? Now you can go through the solution on your own. I'm going further. Was it difficult or something? Look at this. Agree na, guys? Now fourth question. So look at the solution they have given, but it can be very easy question. Sun Limited recently made a profit of 200 crore and paid 80 crore, slightly higher than average paid in the industry to which it pertains. Okay, that means 200 crore is the profits PAT and this is the dividend that they have paid. Okay, that means 120 crore they have saved. The average PE ratio of this industry is 9. This is an important information for us. Correct? No? Yeah. The estimated beta of Sun is 1.2. As per balance sheet of Sun Limited, the shareholders fund is 450 crore and the number of shares is 10 crore. Okay. In case the company is liquidated, building would fetch Guys, there are one or two questions more in this category, So I would leave those questions. You can manage on your own, because I did not follow the institute solution pattern. Rather, I gave you the logic, that how you have to think. So on that thought process, if they try to eliminate, or if they make any of the variables as X or unknown, you can solve it. It is important that you have to, there has to be path, has to be path, okay, of thinking. You cannot look at the solution and then decide the solution, okay? That means you are basically mugging up the solution. When you see a question, the solution should be like in front of you, right from start to end. So if I give you the thought process of how to think, you can manage any question. So in this question, they are asking you the loan amount, the premium component. Maybe in another question, they can ask you something else, but the same format. Okay, now, so in this question, basically they're asking you, calculate the valuation of the Sun Limited, okay, value of Sun using PE ratio. Okay, so for PE ratio, I need two data points. Number one, I need earnings and I need PE ratio. So PE ratio is 9 and earnings is 200 crore. Can you see that? So we are already fine. This is an easy question. B, dividend growth model. In order to use dividend growth model, okay, we need some data. We need D1, we need KE minus GC growth. Okay. So guys, here in the question, they have given data. Okay, growth G is given to you. Okay, risk-free return RF is given to you, and RM is given. I don't know whether they've given the beta. Yeah, beta, yes, 1.2 is the beta. So 1.2 is the beta. So using this data, you can use compute KE. Okay, 80 crore is the total dividend. So D1 divided by KE, D1 divided by KE minus GC, where dividend is total, not per share. Okay, if it is total, if it is per share, you get price per share. If it is total, you will get the total value of the company. So it is again very normal. Then C, book value. Okay, they are asking for book value. Here's something they have told, guys. As per the balance sheet of Sun Limited, the shareholders funds is 450 crore. Okay, that is the book value of the equity actually. Then the last question is net realizable value. Further going, they say, as per the balance sheet of Sun Limited, the shareholders funds is 450 crore and the number of shares is 10 crore. In case the company is liquidated, okay, the building would fetch 200 crore more than the book value. Okay, that book value, and the stock would realize 50 crore less. That means you will add 200 to 450 and reduce 50 to get the new value. Look at this, and we are sorted again. Guys, you can manage this question. No, it's a very easy question. I'm not going to do this question. Can you manage question number 5 on your own? You can manage. There is a solution already there. P ratio and long-term growth rate and all that. Do you want me to discuss that, or you're fine? There is no logic to it. See, use me to understand the logics. Don't use me to just kind of revision thing. You do not need revision actually. You want logics between the lines, which you do not know, and that is why when you study something, you are not able to hold on to your concepts because you do not have concepts. You have just gone through some 50-70 questions, and you, on the basis of your photogenic memory, you know how to solve it. But you do not have a concept in your head or a path of solution actually. So once I've given you that between the lines, you will be able to do on your own without my help. Correct? No, you can do this on your own. Why to like it is again very easy question. Again, this question is same that we did now, that buyback sum. It is the same sum, but still let us discuss that. We are like we are having 2-3 questions more. We can sort it out. Okay. One question I'm very interested is a Telbel Limited, the last question of the sheet. Eager Limited has a market cap of 1500 crores and a current market price of 1500. Again, 1500 crores divided by 1500 will give you 1 crore. It made a PAT of 200 crores and board is considering a proposal to buy back. Should I discuss it again, guys? Should I discuss this again, or you can manage on your own again? But I need, see, you can, somebody can say possibly that ma'am is just like, kind of rushing through and she did not do all these sums. But what is the point of me repeating the same sum and same logics again and again? Why not move on to the next question? It is the same sum, guys. There is no difference in the question at all. Again, see, the question is 52.8 crore only. Look at this. Same question exactly. You get 232 point this one and tax and everything, and you get the EPS. In this question, you are supposed to calculate the new EPS. In the last question, they had given you the, yeah, you can manage this. You can manage this. Let's go ahead then. Because see, this is exam time. I would want you to finish quickly move from YouTube and go on to study. You can manage. Yes, I know you can manage. Otherwise, I wouldn't leave only. Okay, fine. That means we have two sums to go. This sum we need to discuss. You are interested in buying some equity stocks of RK Limited. The company has 3 divisions. Okay, division A captures 10%. I would rather shade it. 10% of its industry sales, which is forecasted to be 50 crore. Division B and C captures 30% and 2% of the respective industry sales. So basically, guys, they have given you industry sales, your margin. So what is the total sale of the industry? What is your share in the industry? Okay, so when you multiply your share to the industry total, you will get the total sales of your company with respect to that division. And when you multiply net profit margin to that, you will get PAT from that division. That is what they have done in the question. Okay, which are expected to be 20 crore and 8.5 crore respectively. Division A traditionally has 5%. Okay, division B has 8% and 10%. 3 lakh shares are given and market price current is 1250. The company has not paid dividends since it started its business 10 years ago. However, from the market sources, you come to know that RK will start paying dividend in 3 years' time and payout ratio 30%. Expecting this dividend, you would like to hold the stock for 5 years. By analyzing the past, they would start paying the dividend in 3 years' time. Then mostly they will start paying the dividend from the 3rd year, right? You have determined that RK Limited's required rate of return is 18% and P ratio of 10 for the next year and ending P ratio of 20 at the end of the 5th year are appropriate. This is again one question which I feel is very important from the exam point of view, and you will goof up again. Whether you will be purchasing RK Limited equity at this time based on your 1 year forecast. Relax. So what we can do, you first calculate the PAT. You multiply industry sales, then your percentage share sales, and then profit margin. What you get, guys, is a total PAT from 3 divisions. Then you divide it by number of shares to get your EPS. And you know something? Look at this data. I'm looking for that word actually. Give me a second, that will help you. Tell me one thing, okay, forecasted, look at this. Division A captures 10% of its industry sales, which is forecasted to be 50 crore for the industry, that is for the next year. That means what you calculated was not EPS, it was actually EPS 1. All of you, yes or no? What you calculated was not EPS 0, it was EPS 1. Okay, and that is why what they did, they multiplied the PE multiple prevailing at the end of 1 year 10, it is given in the question, 249, discounted back to 0. So basically you are standing here 1, 2, 3, 4 and 5. So this EPS is applicable for here into 10, okay, and then you discount that value to here and you are sorted. Then in the second part they are saying price you will like to pay for the stock of RK Limited if you expect earnings to grow at the rate of 15% per annum continuously. Okay, in that case, guys, I think there is a problem in the question. You know what? 24.9 is first year, right? No? So 24 point, what is the growth rate? Can you anybody tell me? I find something 24.9 plus 15% gives me 28. You tell me something, guys. Don't you think this should be 24.9 only? I think this is a mistake. Why? I think the EPS that you calculated above was already standing at the end of the first year. Agree? There is a mistake in the question, I feel. The EPS that you calculated in the first part of the question is standing at the end of the first year. So on that basis, the first year EPS should be 24.9, the second should be 28.64, third should be, yes, all of you agree on that? So on that basis, if you see the question has, yeah, so but they have not, they have assumed 24.9 to be at 0. That is a mistake in the question. Rest the question is very, very manageable. There is nothing new in the question actually. So they started paying dividend at the rate of certain percentage. Okay, you take out that. Okay, and you discount all the cash flows, bring it to 0 and get the answer. Again, there is nothing in the question once you understand. So I feel this column is not correct because the first should be 24.9, second should be 28.64, third one should be 32.93, fourth should be 37.87 and fifth should be 43.55. This should not be there. This should be now here then. No, it is 24.9 is not EPS 0, it is EPS 1 because the question says projected, predicted, forecasted. So EPS that you calculated above should be ideally EPS 1 and not EPS 0. They have assumed it to be EPS 0. Last question on the sheet. Okay. This is again very important question from the exam point of view. If it comes not less than 10 marks, it is a rights issue sum. Do you agree with that, that it should be EPS 1, all of you? There are 12 people sitting out there. Why don't you say it? Telbel Limited is considering undertaking a major expansion on an immediate cash outlay of rupees 150 crore. Correct. Telbel Limited is considering undertaking a major expansion on an immediate cash outlay of rupees 150 crore. Okay. The board of directors of a company are expecting to generate an additional profit of 15.3 crore after a period of 1 year. Okay. This question is of rights issue, guys. Okay. So it is a very, very nice and lengthy question, but you need to understand few things here. If you understand that part, I don't need to solve the question only. Okay. So wherever you did rights issue sum, what were you doing? And P0 into N0 plus P1 into N1, the whole divided by N0 plus N1 to compute the X rights price. Agree? Now, the money that you were raising, okay, the money that you were raising in order, by issuing the right shares, that money was supposed to be put up in the project. Okay, na? But the question never mentioned beyond that. That means they never went beyond in the question that their money was invested and the company generated NPV and so on. Okay, that is the difference between those questions and this question. You will understand exactly what I'm trying to say once I proceed further with the sum. Telbel Limited is considering undertaking an expansion of an immediate cash outlay of rupees 150 crore. That is the cost of the project. The board of directors of a company are expecting to generate an additional profit of 15.3 crore after a period of 1 year, naturally. Further, it is expected that this additional profit shall grow at the rate of 4% per annum for an indefinite period in the future. So basically, they have given you cash flow, they have given you growth rate, and they have also given you cash outflow. What you need is only the discounting factor. If you have the discounting factor, you can compute the NPV. The PV of the cash flows would be 15.3 into 1.04, the whole divided by KE minus GC. That will give you the present value of the cash flows. Minus 150 crore will give you the NPV of the project. Let us see what they want. Presently, Telbel Limited is completely equity financed and has 50 crore shares of rupees 10 each. The current market price of each share is 22.6 cum dividend. Okay. The company has paid a dividend of 1.4. That means 22.6 minus 1.4 will be the value of X dividend. I would need an X dividend price to compute the cost of equity for the last, and also dividend amount in order to compute the cost of equity. That means 1.4, okay, 1.4 into 1.06, the whole divided by 22.6 minus 1.40, okay, whatever formula that I have to use, I will have to use in order to compute KE. Okay. So the board of directors are considering. So now the board of directors are thinking how to raise this 150 crore. Whether they should go with a rights issue of 1:5 at a price of 15. 15 is the subscription price. Okay. a public issue of the shares. They have two choices with them. So you have to say which one to go for. Okay. In both the cases, the dividend shall become payable after 1 year. Determine whether it is worthwhile to undertake the project or not. That means you have to compute the NPV of the project, as I told you at the start of the question. But for that, you need to calculate KE. How would you do that? So basically, can you not do like this? KE is equal to D1 by P0 plus G, correct? So D1 will be 1.4, okay, and 1.4 plus 6%, 1.4 plus 6% will become D1, 1.484, okay, divided by 22.6 minus 1.4 gives me 21.2, okay. So 1.4 plus, you should use your calci guys, 1.4 plus 6%, okay, divided by 21 point, what was that value, 21.2, sorry, divided by 21.2 and plus 0.06 into 100 will give me 13%, 13% is your KE. So now you can compute the NPV of the project. How will you do that? So 15.3 and plus 4%, okay, divided by 0.13 minus 4 will give you 0.09. So value of the present value of cash flows is 176. Did we get that? Yeah, that's correct. Did I calculate wrong? So 15.3, what is the growth rate? 4% only. So 15.3 plus 4%, 15.912. Okay, they have not taken, is it? Okay, sorry. This is already CF1, sorry. Arey yaar. I have not put up the project now. I will put up the project now. I am contemplating whether to put the project or not. I am standing at 0. Okay, so if I invest 150 crore today, from next year it will be 15.3. Correct? It is already D1 actually, or cash flow 1. So don't need to adjust the growth rate again. That is completely okay. CF1. Okay, so CF1 15.3 divided by 0.09 will give you 170 crore. 170 crore minus 150 will give you 20 crore. So the NPV of the project is positive, and hence we must go ahead with the project. So that part is sorted, that you have to put up the project. Now it is about funding. How do you want to fund the project? Again, it has to be equity only, because it is, the company is all equity financed. So whether you want to go with the rights or you want to go for the public thing. That, you know what is the difference? That means you want to issue the shares to the existing shareholders only, or you want to go for the outside shareholders. That is the logic. Okay, now the next question is that calculate ex-dividend market price of the share if complete expansion is financed from the rights issue. Ex-dividend market price of the share if the complete expansion is financed from the rights issue. You know what, I can do the way they have done, but I personally think that I can help you better. So what will be the X rights value? Do you remember? Please be careful. So when you write P0 into N0 plus P1 into N1, do you agree with the fact that you need to answer here? After that, you don't need to answer. This part is nothing but the desired funds, all of you. This P1 N1 is nothing but that 150 crore basically that you wanted to raise. You wanted to raise 150 crore, and if you raise at the price of P1, then N1 number of shares will have to be raised. Agree, all of you? If I think this equation in terms of total, not per share, how does it matter to you? Yes. So basically P1, yes, P1 into N1 is nothing but the desired amount of funds that we need to put up the project. So I was telling you something before I started the sum technically, right? So what I'm trying to tell you is that we never saw in a question where they mentioned that 150 crore became 170 crore. But in this question they have mentioned, and hence in this question P1 into N1 will not be 150 crore. You have to put 170 crore. Be aware of that. And this P0 N0 will be nothing but that price that is existing, 21.2 multiplied with the number of shares. How many shares are existing here? 50 crore shares. 50 crore shares they have. So 50 crore shares into 21.2. Do it. 50 crore shares into 21.2 plus 170. Okay. Divided by. Now, look at this. They have given a ratio of 1:5. That means if you already have 50 crore shares and you want to maintain a ratio of 5:1, then you will issue 10 crore more shares. Divided by 60 crore. Okay, I get, what did I do? Okay, 21.2 into 50. Okay, then plus 170 equal to divide by 60. I get 20.5 and this is my answer. I don't know what they have done, but this is how I have calculated. So the only difference here is that in the previous questions you were using only the outflow part. In this question you are using, that means 170 crore is a new addition to your book. Okay, if you consider only the outflow part in the project, you raised 150 crore more of equity, okay, by offering rights that will be added to your book. But as I told you that NPV adds up directly to the wealth of the shareholders. So now in this question, 150 crore will be added definitely, because that is additional money that you're going to raise in the form of rights. But 20 more would be added because that is the NPV and that will add up to the wealth of the shareholders. Okay. So we are done here, guys. Now about the public issue. They are saying that calculate the number of, this is done. Calculate the number of new equity shares to be issued and at what price, assuming that new shareholders do not suffer any loss after subscribing to the new shares. Okay. So what you are going to do, you are going to compute the total value of the book. So what is the total value of the book? Total value of the book will be 21.2 into 50 CR and plus 170 CR. So 21.2 into 50, okay, plus 170 will give me 1230 crore. Look at this. So this is the total value of the book. This will be the total value of the book, okay, post the project, okay, post the project. And how much do you want from them? They are saying what are the number of shares wherein they are neither better off nor worse off. You know what did they do? The number of shares that need to be issued to the public divided by 50 crore plus the new shares. This is shareholding of the new shareholders multiplied with the total market value of the equity should be equal to 150 crore and you get a value of 21.6. Okay, and the number of shares that you get is 6.9444. Guys, are you fine with this? And further going, you have to do nothing but you have to compare the two, which is very, very manageable actually, very, very manageable. So shareholders current wealth is 21.2 into 50 crore is 1060. Value of 60 crore at the rate of 20.50 is 1230 crore, but the shareholders are paid 150 crore. So again, you are neither better off nor worse off. Same for the second part also, guys. You can manage that, not a problem at all. So was it difficult, all of you? Was it difficult? Okay, so we wind up for today, guys. Equity is done. Okay, so tomorrow we're going to start with Forex lecture actually. Okay, so let's find up and we'll discuss about the timings and everything on the group, because we do not want to spoil on the lectures part timing, because many other students are there who do not mind or who are like, let's not waste time here. We can do on, that is why I've done the group, so that I am able to connect with you. Because if I have to say something, where do I say? I don't know who other people are attending. Okay, any which ways. Okay, so let's wind up. Bye bye. Good night. You need to practice. Yeah, it is a tough question, but it is very, very logical question actually. You need to practice. Write and practice, please. Bye bye. Thank you. Bye bye.